A lot of Americans are now paying more than $700 a month just for a car payment. And the problem is not only the monthly payment itself. Insurance is higher, repairs are higher, interest rates are still elevated. Even basic maintenance costs more than it did a few years ago. For many households, transportation is quietly becoming one of the biggest financial pressure points in their budget. And I think a lot of people did not fully expect how expensive owning a car would become this quickly. In the next few minutes, I am going to break down what this means for your money, what could happen next, and what I would personally pay attention to right now. Jessica is 38 years old. She lives outside Phoenix, Arizona. She works as a medical office coordinator and earns about $68,000 a year. Her husband works in construction. Together, they have 2 kids. A few years ago, they traded in an older SUV because repair costs kept piling up. At the time, buying a newer vehicle felt like the safer financial choice. Their monthly payment ended up around $740. At first, they thought they could manage it. But over time, other costs kept rising too. Insurance went up. Gas prices stayed unpredictable. Groceries became more expensive. And then interest rates climbed across the economy. Now, even though both adults are working full-time, Jessica says it feels harder every month just to stay ahead. And this is not an isolated situation anymore. The average new car payment in America is now above $700 per month in many cases. For some buyers, especially those financing larger vehicles, payments are getting close to $1,000 monthly. Part of the reason is simple. Vehicle prices increased sharply after the pandemic because supply shortages pushed prices higher. Then, even after inventory started improving, borrowing costs stayed elevated because of higher interest rates. That means many Americans are now financing expensive vehicles at expensive rates. And even used cars are still much more costly than they were a few years ago. Before I go further, this is not financial advice. Everything here is purely educational. And you should always speak with a licensed financial professional about your own situation. What makes this situation important is how connected it is to the broader economy. When families spend more on transportation, they usually cut spending somewhere else. That can mean fewer restaurant visits, delayed vacations, smaller savings contributions, or increased credit card usage. And once households start relying on debt to manage everyday expenses, financial pressure tends to build gradually. There are 3 important things I think you should pay attention to here. The first thing I would pay attention to is how long auto loans are becoming. More Americans are now taking out 6-year and even 7-year car loans just to make monthly payments feel manageable. The issue is that smaller monthly payments often come with a bigger long-term cost. If someone finances a vehicle for 84 months, they can end up paying thousands more in interest over the life of the loan. And this matters because cars lose value over time. So in many cases, people owe more on the vehicle than the car is actually worth for several years. That creates a difficult situation if someone suddenly needs to sell the vehicle, trade it in, or deal with a job loss. I think this is the part many people are underestimating. A practical thing I would personally do right now is review the exact length and interest rate of any existing auto loan. A lot of people focus only on the monthly payment and ignore the total cost. And once you understand the full picture, it becomes easier to decide whether refinancing or paying extra toward principal makes sense. The second thing I would watch closely is rising delinquency rates. More borrowers are starting to fall behind on car payments, especially among lower and middle income households. And when people miss payments, the financial damage can spread quickly. One practical step I would consider is checking your credit score and reviewing automatic payments. Insurance costs can even rise in some situations. Recent lending data shows serious auto loan delinquencies climbing back toward levels not seen in years. That tells me many households are reaching a financial breaking point little by little, not all at once. And this is where the ripple effects start showing up, because when transportation becomes unstable, getting to work itself can become stressful. For people living in areas without strong public transportation, losing access to a vehicle can affect income almost immediately. One practical step I would consider is checking your credit score and reviewing automatic payments. Sometimes a small missed payment creates a much larger financial problem later. The third thing I would pay attention to is how high interest rates are changing buying behavior. A few years ago, low rates made larger vehicle purchases feel easier for many families. Today, financing costs look very different. Even buyers with decent credit are often seeing auto loan rates above 6% or higher, depending on the lender. That can add hundreds of dollars monthly compared to loans issued during lower rate periods. And because payments are higher, many Americans are keeping older vehicles longer instead of upgrading. That sounds reasonable at first, but older vehicles can also bring repair uncertainty and maintenance costs. So families are getting squeezed from both directions. Either the payment is too high, or the repair bills become unpredictable. Think about what that means over a full year. A practical move right now could simply be delaying a non-essential vehicle purchase if your current car is still reliable enough to get by safely. In a high-rate environment, patience can sometimes save a significant amount of money. Now here's how I personally look at all of this. I do think transportation costs are becoming one of the most underestimated financial issues in the country right now. Not because everyone is about to stop paying their loans, and not because the economy is suddenly falling apart, but because so many households are already stretched thin from higher costs in multiple areas at the same time. When groceries rise, housing rises, insurance rises, and debt payments rise together, even stable incomes start feeling smaller. At the same time, I also think some of this is manageable with awareness and small adjustments. Most financial problems become more dangerous when people avoid looking at them directly. The families that usually handle periods like this best are the ones paying attention early. First, I would personally review every recurring transportation expense this week, including insurance, gas spending, and subscriptions tied to the vehicle, because small monthly increases add up faster than most people realize. Second, I would compare auto insurance rates. A lot of companies have raised prices aggressively recently, and even switching providers could reduce costs. Third, I would avoid stretching a budget just to buy a newer vehicle right now unless it is absolutely necessary, because interest costs remain elevated. Fourth, I would build even a small emergency repair fund if possible. Even setting aside a little money monthly can reduce stress later. Fifth, I would monitor credit carefully and avoid missing payments whenever possible, because borrowing costs across the economy are heavily tied to credit quality right now. The people who stay informed and make small adjustments early usually handle periods like this much better than the people who ignore it completely. So when you step back and look at the bigger picture, there are really three major things happening here. Auto loans are getting longer and more expensive. More Americans are falling behind on payments. And higher interest rates are changing how families think about transportation altogether. For many households, owning a vehicle is no longer just a routine expense. It is becoming a major financial decision that affects everything else in the monthly budget. If this helped you understand what is happening a little more clearly, subscribe.